Most people never ask the most important question about their money. They ask how much they earn, they ask how much they spend, they ask whether the bank account is enough, they ask whether they can afford the next bill, but they almost never ask this. While I am working for money all day, what is my money doing for me? If you wake up at 7 in the morning, spend an hour getting to work, work 8 hours, then spend another hour getting home, you've given 10 hours of your day to money. 10 hours, your body worked, your attention worked, your energy worked, your time disappeared, and yet your money may be sitting in a bank account earning almost nothing. You are awake, but your money is asleep. That is the imbalance most people live with. It is not that they are lazy, they are not. Many people work very hard. It is not that they are stupid, they are not. Many people simply never built a system where money starts working while they are not working. That is the core problem. A paycheck is active, a bank balance is passive in the worst sense if it earns almost nothing and loses purchasing power to inflation. An investment system is passive in the better sense when it keeps working without demanding 10 hours of your day. This is why $10,000 matters. Not because $10,000 makes you rich, it does not. Not because it solves your life, it does not. $10,000 matters because it is large enough to build a real system, but small enough that ordinary people can still reach it. It is a psychological milestone. When your account reaches 5 figures, you begin to understand that money can become a worker, not only a stored number. That shift changes how you see everything. Most people think the question is, what should I buy? That is not where I would start. The first question is, what system should this $10,000 enter so it can survive, grow, and keep me from doing something foolish when fear shows up? Because investing without a system is not investing, it is guessing. And guessing with hard-earned money is not courage, it is avoidable risk. The first principle is this: the goal is not to make one brilliant move. The goal is to build a system that can keep working when your emotions cannot. Many people hear the word investing and immediately picture stress. They imagine staring at stock charts, watching red numbers, chasing hot companies, trying to predict the next market crash, or waking up afraid that they made the wrong decision. If that is what investing feels like, then the plan is already wrong. A good asset allocation system should feel more like setting a washing machine. You choose the cycle, you press start. You allow the machine to do its job. You do not stand there yelling at the close every 3 minutes. That may sound too simple, but simplicity is often what makes a system survive. Most people fail because they build an emotional relationship with every market move. They buy because something feels exciting. They sell because something feels frightening. They follow a friend's tip. They chase a video. They compare funds for weeks and then do nothing. They confuse activity with intelligence. The market does not reward unnecessary activity. It rewards disciplined ownership over time. That is why we must begin by breaking 3 myths. The first myth is that investing is dangerous and saving is safe. It sounds reasonable because a bank account feels stable. The number does not move up and down every day. If you deposit $10,000, the account still says $10,000 tomorrow. That creates a feeling of safety. But safety is not only about whether the number changes. Safety is also about what the number can buy. If inflation is around 3.3% and a 1-year deposit yields around 1.9%, then the money is not really growing. It is shrinking in purchasing power by roughly 1.4% per year. The bank account looks stable, but the buying power is being quietly reduced. Over 10 years, $10,000 can feel like it is still there, while the real purchasing power has fallen. The source describes that purchasing power falling toward about $8,700 in real terms, under those assumptions. That is not safety, that is slow erosion with a calm account statement. This is the second principle. Money sitting still in nominal terms can still be moving backward in real life. Inflation is the hole in the bucket. You can work hard carrying water up the mountain, but if the bucket has a hole, the effort does not create the outcome you expected. Many people save with discipline, and that discipline is admirable. But if the money earns less than inflation for years, the real value leaks away. That does not mean cash is useless. Cash is very useful. Cash creates stability, cash gives you time, cash protects you from emergencies, but too much cash for too long can become a hidden loss. Cash is a tool for safety and liquidity. It is not a complete wealth building strategy. The second myth is that you need a lot of money to start investing. Many people think investing begins when you have hundreds of thousands of dollars. They look at $10,000 and think it is too small. They think they should wait until the amount feels serious. That is a mistake. $10,000 is a strong starting line because it is enough to build structure, it is enough to divide into layers, it is enough to create emergency protection, market exposure, and opportunity capital. It is enough to teach your brain what it feels like to own assets. The amount does not have to be enormous. The system has to be real. Going to the gym with 10-pound dumbbells is not pointless, because the dumbbells are not heavy enough to impress anyone. The point is to build form, habit, and consistency. Once the habit exists, strength can increase. Investing works the same way. $10,000 teaches structure, it teaches allocation, it teaches discipline, it teaches emotional control, it teaches what it feels like when markets fall and the system keeps you from panicking. That is the third principle. The first investment system is not only about return, it is about training behavior. The third myth is that investing means spending hours researching stocks. If you are a professional investor, research may be your job, but most people are not professional investors. They have work, family, health, sleep, and limited time. For most people, spending 3 hours every night studying individual stocks is not only unrealistic, it may also be unproductive. The passive investing mindset begins with humility. The market is a complex system. Millions of participants are analyzing information. Prices reflect expectations, fear, greed, interest rates, earnings, liquidity, and human behavior. Trying to beat that system consistently is extremely difficult. So instead of trying to beat the market, most people are better served by joining it. Own broad market ETFs, own a balanced allocation. Buy consistently, rebalance occasionally, do not overtrade, do not pretend you know more than the entire market. This is not weakness, it is wisdom. The fourth principle is this: passive investing is not laziness. It is the recognition that your time and emotional energy are valuable. If your time is better spent improving your career, building skills, strengthening relationships, sleeping properly, and living your life, then a simple investment system can be a superior strategy. The goal is not to stare at screens, the goal is to make your money work while you do things that actually matter. Now, why $10,000? Because $10,000 can create the first emotional proof that money works. Assume a 6% annualized return, that is about $600 a year, around $50 a month. $50 a month may not sound like much. It will not replace your job. It will not pay your rent. It will not make you financially free. But it is not nothing. It is money produced by money. It appears while you sleep, while you rest, while you spend time with family, while you are not trading hours for dollars. The first time you see passive income appear in an account, even if the amount is small, your relationship with money changes. You realize that income does not have to come only from labor. That realization is powerful. It is the psychological beginning of financial independence. This is the fifth principle. The first passive income payment matters less for its size and more for what it teaches you. It teaches you that ownership pays. It teaches you that capital has behavior. It teaches you that money can begin to move without you pushing it every hour. That feeling can change how you work, spend, save, and invest. But here is the problem. Most people never reach that feeling because they never create a system. They watch videos, hear a fun name, buy something emotionally, lose interest, panic during a decline, or forget the plan entirely. They do one intense action, then stop. That is like wanting a healthy body running 10 miles once and then doing nothing for 3 months. A system does not work that way. The body changes through repeated training. Money changes through repeated allocation. That is why the $10,000 system must have layers. A portfolio is not one pile of money, it is a set of jobs. Some money must protect you, some money must grow. Some money must wait for opportunity. If all money has the same job, the system becomes fragile. The source set structure divides $10,000 into 3 layers. 20% safety net, 60% growth engine, 20% opportunity bullets. That is $2,000, $6,000, and $2,000. This structure is simple, and because it is simple, it can be followed. The first layer is the safety net, $2,000. This money is not for investing, that is very important. It belongs in a high-yield checking account, savings plan, short-term deposit, money market fund, or another low-risk liquid place depending on your situation. Some people hear this and say, why keep 20% in cash? Isn't T that inefficient? Shouldn't T all $10,000 be working? That question misunderstands what the safety net does. The safety net is not designed to maximize return. It is designed to keep the system alive. A car repair happens, a pipe bursts, a job gets unstable, a medical bill arrives, an unexpected family need appears. If you have no safety net, you may be forced to sell investments at the worst possible time. The market may be down, your account may be temporarily negative. If you sell, then the temporary loss becomes permanent. Many people fail at investing not because the investments were bad, but because life forced them to sell too early. That is the sixth principle. Liquidity is what allows long-term investments to remain long-term. Without liquidity, every emergency becomes an investment decision. That is dangerous. The safety net creates psychological security. When you know there is cash available for near-term surprises, you can let the growth engine fluctuate without panicking. You are not forced to sell at a bad price because the washing machine broke or the car needed repair. This is why the safety net is not wasted. It buys staying power. Staying power is one of the most underappreciated assets in investing. A person with a good portfolio and no cash may be forced out during a downturn. A person with a slightly smaller portfolio and enough cash can stay in the game. The second person may win over time because they survived. That is the seventh principle. Survival is the first requirement of compounding. The second layer is the growth engine. $6,000. This is the core of the allocation. Its job is long-term growth. The source uses a mix of global stock ETFs and bond ETFs. Specifically, it places 70% of the $6,000 into broad stock market ETFs like VTFU or VTI and 30% into bond ETFs or investment grade corporate bonds. This creates a 70-30th structure inside the growth engine. Stocks provide growth. Bonds provide stability. Stocks represent ownership of businesses. Over long periods, broad stock markets have historically produced strong returns because companies innovate, sell products, earn profits, reinvest, and distribute value to shareholders. But stocks are volatile. They can decline sharply. They can make investors uncomfortable. Bonds are different. They generally provide lower returns, but they can help stabilize the portfolio. In many downturns, high-quality bonds may hold up better than stocks, and sometimes they rise when stocks fall. They are not perfect. Bonds can lose value too, especially when rates rise. But in a balanced portfolio, they can reduce the stomach-churning swings that make people abandon the plan. That is the eighth principle. The best portfolio is not always the one with the highest theoretical return. It is often the one you can actually hold. Through fear, a 100% stock portfolio may produce higher long-term returns in theory. But if you panic during a 30% decline and sell near the bottom, your personal return will be far worse than the market's return. A balanced portfolio may grow slightly slower, but if it keeps you invested, it may produce better real-world results. This is why the 70-30th structure matters. It balances growth and emotional durability. The third layer is the opportunity bullets. $2,000. This money is flexible. Its job is to be available when the market falls meaningfully. The source uses a personal rule. When the broad market drops more than 15% from its peak, begin deploying the opportunity money in batches. This is important. Most people say they want to buy the dip, but when the dip comes, they have no cash. Or they have cash but no rule, or they have a rule but no courage. The opportunity layer solves part of that problem. It creates cash that is already reserved for downturns. When everyone else is panicking, you are not surprised. You knew this layer existed for that moment. That gives you a psychological advantage. The money may sit in a money market fund or short-term ETF earning a modest return while it waits. It may earn 2 or 3%, it is not fully idle, but its main purpose is optionality. This is the ninth principle. Cash waiting for opportunity is not laziness if it has a rule. The danger is idle cash with no plan. Opportunity cash with a plan is different. If the market keeps rising, that $2,000 may underperform the stock allocation. That is the trade-off. You gave up some upside in order to keep flexibility. But when markets fall, that flexibility becomes valuable during the 2022 decline. The source describes using this opportunity fund while others were panicking. When the market recovered in 2023, the money deployed during fear gained strongly. That is the role of opportunity bullets. They let you act when emotion in the crowd is worst, but they must be governed by rules. If you use the opportunity bullets on every small dip, they disappear before the real opportunity arrives. If you never use them because you keep waiting for the perfect bottom, they fail their purpose. The 10th principle, opportunity capital needs a trigger. A trigger turns fear into action. For example, a 15% broad market drop can be a trigger. Some people may use 10%, some may use 20%. The exact number is personal. The important thing is to define it before the market is falling. Rules made during calm are usually better than decisions made during panic. Now let us look at the system as a whole. $2,000 protects you, $6,000 grows, $2,000 waits for dislocation. This is a simple portfolio architecture, safety net, growth engine, opportunity bullets. It is not complicated. That is why it works. It gives every dollar a job, and when every dollar has a job, you stop making emotional decisions with the whole pile. That is the 11th principle. Money without a job gets pulled around by fear and impulse. Now, let us talk about execution. A system that cannot be executed is only an idea. Step 1 is opening a brokerage account today. This can often be done online in minutes with identification and bank information. The broker should be low-cost, user-friendly, and allow ETF investing with minimal friction. Many major brokers offer zero-commission ETF trading. The point is not to spend 6 months looking for the perfect broker. The point is to remove friction. Step 2 is setting up automatic transfers. This is crucial because human nature is lazy and emotional. If you must manually decide every month, you will eventually find reasons not to do it. Something will feel urgent. The market will feel risky. A purchase will tempt you. You will postpone. Automation reduces negotiation. The money moves before your mood gets a vote. That is the 12th principle. Automation is discipline installed in advance. If the transfer happens automatically when your paycheck arrives, investing becomes normal. After a while, you may barely notice it. That is a good thing. The goal is to make investing part of the operating system of your life. Step 3 is choosing ETFs. If you do not know what to choose, a broad total market ETF can be enough to begin. Funds like VTI, VUO, or VT represent different ways to own broad markets. V2 tracks the SP 500. VTI tracks the total US stock market. VT gives global stock exposure. Each has a different scope. The correct choice depends on whether you want US only or global exposure, and how simple you want the portfolio to be. Do not get trapped trying to identify the absolute best ETF. There is no perfect fund. There is only a fund that fits the role. A good broad ETF, low cost, diversified, held for a long time, can do more for most people than endless comparison and no action. That is the 13th principle. The perfect portfolio you never start is worse than the good portfolio you actually fund. Step 4 is rebalancing. Rebalancing means returning the portfolio to its target allocation. Suppose your growth engine is 70% stocks and 30% bonds. After a strong year for stocks, the mix may become 80% stocks and 20% bonds. The portfolio has drifted. It now has more stock risk than intended. To rebalance, you sell some of what went up and buy some of what lagged, bringing the portfolio back to 70 and 30. This feels counterintuitive. The human brain wants to keep buying the winner. Rebalancing forces discipline. It makes you sell some strength and buy some weakness. It is a built-in way to sell high and buy low. The source suggests doing this once every 6 months. That is a reasonable rhythm for many people. It is not so frequent that it becomes obsession, but often enough to keep the portfolio aligned. That is the 14th principle. Rebalancing is how the system corrects your emotions without asking your permission. When stocks have surged, greed tells you to increase risk. Rebalancing says return to target. When stocks have fallen, fear tells you to avoid them. Rebalancing says buy back toward target. This is how a simple rule can protect you from yourself. Step 5 is to keep learning, but not overreact. This is a delicate balance. You should understand the world. You should learn. You should read. You should know the basic macro environment, interest rates, inflation, earnings, recessions, valuations, and policy. All matter, but learning should not become constant tinkering. The source suggests 1 to 2 hours a month reading or watching financial material to understand broad trends, not to chase short-term swings. That is enough for many passive investors. The goal is awareness, not addiction. Retail investors often underperform market indices by 3 to 5% because they trade too frequently and make emotional decisions. They buy high, sell low, chase trends, and abandon plans. The boring strategy often wins because it avoids the self-inflicted damage. That is the 15th principle. The market is hard enough. Do not add unnecessary mistakes. Buy, hold, rebalance. Keep contributing. This does not sound exciting, but it is powerful precisely because it is not exciting. Now, what return can a system like this reasonably aim for based on historical data? A 70 divided by 30 stock bond portfolio has often produced long-term annualized returns around 6 to 8%, depending on the period, the specific assets, interest rates, inflation, fees, and rebalancing. The source uses 7% as an example. At 7%, $10,000 becomes nearly $20,000 in 10 years. In 20 years, it grows to over $38,000. In 30 years, it becomes over $76,000. And that is without adding more money. This is the key. The initial $10,000 alone can grow, but the truly powerful version adds contributions. If on top of the initial $10,000 you invest $200 every month, the source projects that the total can grow to over $300,000 in 30 years. This is the force of compounding combined with repeated contributions. The 16th principle, the first $10,000 starts the system, the monthly contribution feeds the system. The compounding curve is created by both. Some people focus only on finding a high return, that is, incomplete return matters. But contribution rate and time matter too. A moderate return with consistent contributions can beat a great return applied to money that was never invested. This is why the system has to be practical. It must include the initial allocation and the ongoing behavior. Now, let us be honest. The path will not be smooth, markets fall, sometimes sharply. In March 2020, the pandemic shock pushed markets down fast. Many accounts fell 30% or more. It felt terrible. People wondered whether the world economy was breaking. Headlines were frightening. Selling felt emotionally reasonable, but a good system had already prepared for that moment. The bond allocation provided some cushion. The safety net reduced the need to sell. The opportunity bullets gave the investor a way to buy into fear. The rebalancing rule helped restore the target allocation. The automatic investment plan kept moving. This is why systems matter most during stress. Anyone can feel confident when the market is rising. The real test comes when the account is down. The 17th principle, your biggest enemy in investing is not usually the market. It is the emotional decision you make because of the market. When the market falls, the feeling is real, the fear is real. But the feeling is not always a good guide. A system exists to keep you from turning temporary volatility into permanent loss. If you sell during a decline, you may lock in the loss and miss the recovery. If you hold and rebalance, you may endure discomfort but participate in the rebound. That is the difference between emotional investing and system investing. Now, there is another important point in the source. Your investment returns are not your only source of wealth. Your human capital may be your largest asset. If you are 30 years old and earn $60,000 per year until age 65, that is over $2 million of lifetime salary. Before considering raises, your ability to earn improved skills, change roles, build networks, and increase income can have enormous financial value. Many people obsess over whether their portfolio returns 6% or 7% while ignoring their income potential. That is backwards. Especially early in life, your human capital is the main engine that feeds the portfolio. If your salary rises from $60,000 to $120,000 and you keep lifestyle controlled, the amount you can invest can increase dramatically. That may accelerate wealth more than searching for a slightly better ETF. That is the 18th principle. Investing makes your money work. Skill building increases how much money you can put to work. You need both. A person who invests well but never grows income may move slowly. A person who grows income but never invests may spend everything. The strongest system combines both higher earning power and disciplined asset allocation. This is how wealth compounds faster. The source gives an example of a friend who started with $10,000, but also worked hard to improve professional skills. His salary rose from $60,000 to $120,000. Because income rose, he could invest more every year. His portfolio reached over $100,000 by age 38 and continued growing. That story contains an important lesson. The portfolio return was not the only driver. Human capital created the surplus. The surplus fed the portfolio compounded, that is the system. The 19th principle, your career is the income engine, your portfolio is the capital engine. Financial freedom requires both engines to be aligned. Now let us talk about what the $10,000 allocation is really doing. The 20% safety net protects you from forced selling. The 60% growth engine gives you long-term exposure to business and bond returns. The 20% opportunity fund gives you courage and cash during market declines. Automatic transfers keep the habit alive. Dollar cost averaging reduces timing anxiety. Rebalancing prevents the portfolio from drifting into unintended risk. Continued learning keeps you informed without making you reactive. Human capital growth increases the money you can invest together. These pieces create a system that is stronger than any single stock pick. That is the 20th principle. Wealth building is a system of interacting parts, not one isolated decision. This is how I would think about $10,000. If you simply leave it in the bank, it may feel safe. But inflation keeps moving. If you throw all of it into stocks at once, you may panic during the first decline. If you keep all of it as cash waiting for a crash, the market may rise without you. If you chase hot stocks, you may turn a serious milestone into speculation. But if you divide it into layers, automate the process, rebalance, and keep learning without overreacting, the $10,000 becomes the beginning of a machine. That is what matters. Now, let us think about the phrase lazy way. Lazy does not mean careless. Lazy means the strategy does not require constant activity. It does not require day trading. It does not require chart watching. It does not require predicting every market top. It does not require perfect timing, but it does require upfront structure. It requires choosing the allocation. It requires opening the account. It requires setting transfers. It requires accepting volatility. It requires rebalancing. It requires not sabotaging the system. This is disciplined laziness. That is the 21st principle. The best passive strategy is lazy in execution, but serious in design. Bad laziness means doing nothing. Good laziness means building a system that does not need constant intervention. There's a big difference. Now let us think about why people keep money in the bank even when it loses purchasing power. Fear, confusion, habit, distrust of markets, bad past experiences, family beliefs, no system. These are all understandable. Markets can feel intimidating. Losing money on paper feels bad. Opening a brokerage account can feel like crossing into a world you do not understand. The language can be confusing, but fear does not stop inflation. Confusion does not stop purchasing power loss. Waiting does not eliminate risk. It simply chooses a different risk. The 22nd principle. Doing nothing is also a decision, and it has consequences. Leaving money idle may feel neutral. It is not neutral if inflation is reducing buying power. That is why the best response is not reckless action. It is structured action. Start with a system that includes safety. That is what the 20% cash layer does. It gives you enough stability to take reasonable growth risk with the rest. Now let us talk about dollar cost averaging. The source suggests taking the $6,000 growth engine and spreading it over 6 months, investing $1,000 per month. This reduces the emotional risk of investing everything right before a decline, mathematically. Lump sum investing is often performed well over long periods because markets tend to rise more than they fall. But psychologically, lump sum investing can be difficult if you invest all at once and the market drops the next week. You may panic and abandon the plan. Dollar cost averaging is not always mathematically superior, but it can be behaviorally superior. That matters. The 23rd principle, a slightly less optimal strategy you can follow, may be a theoretically better strategy you abandon. Investing $1,000 a month for 6 months gives you time to adjust emotionally. It spreads entry prices. It makes the transition from cash to invested assets less frightening. This can be especially useful for beginners. The goal is to get invested without creating emotional overload. Now let us think about asset allocation as risk control. A 70 divided by 30 portfolio is a balance. 70% stocks provide growth, 30% bonds provide ballast. If you are younger, have high risk tolerance, and can handle volatility, you might use more stocks. If you are older, more conservative, or need money sooner, you might use fewer stocks. The source uses 70 divided by 30 because it is a practical middle ground. But no allocation is perfect for everyone. The 24th principle, asset allocation should match your time horizon, risk tolerance, and emotional capacity. Do not copy a ratio blindly. Understand why it exists. If you cannot sleep with a 70 divided by 30 portfolio, adjust. If you can tolerate more volatility and have decades, you may choose more equity. If the money is needed soon, it should not be heavily invested in stocks. Context matters. Now, let us discuss bonds. Some people dismiss bonds because returns are lower. That is a mistake. Bonds are not in the portfolio to make you rich quickly. They are there to stabilize. They can reduce volatility, provide income, and create rebalancing capital when stocks fall. In a crash, the bond allocation may hold up better. Then rebalancing can move some bond money into stocks at lower prices. This is how bonds can indirectly support long-term returns. The 25th principle, the stabilizer in a portfolio can become the source of buying power during stress. That is why stability has value, not only because it reduces fear, but because it can give you capital to buy risk assets when they are cheaper. Now let us talk about stocks. Broad stock ETFs like VTI, VOO, or VT are ownership vehicles. They give exposure to many companies. They allow you to participate in business growth without picking individual winners. They also expose you to market declines. That is the trade. Stocks are the growth engine because businesses can compound over time. Companies raise prices, innovate, expand, earn profits, and return capital. But stocks are volatile because expectations change quickly. That is why the safety net and bond layer matter. The 26th principle. Growth requires exposure to volatility. If you avoid all volatility, you may also avoid much of the growth. The goal is not to eliminate volatility. The goal is to make sure volatility does not force you out. Now let us think about the opportunity bullets more carefully. Keeping $2,000 for a 15% market decline is psychologically powerful because it turns a crash into a planned event. You do not have to invent courage during panic. The money was already assigned to that job, but the deployment should be in batches. If the market falls 15%, deploy part. If it falls more, deploy more. Do not assume you know the bottom. The purpose is to average into fear, not to perfectly time fear. That is the 27th principle. Opportunity cash should be deployed with rules, not predictions. A 15% drop is not a guarantee that the market will rebound immediately. It may fall further. That is why batches matter. If you deploy everything too early, you may have nothing left if the decline deepens. If you deploy nothing because you wait for perfection, you may miss the rebound. Rules solve this. Now, let us talk about rebalancing after a crash. When stocks fall, your portfolio may become underweight stocks relative to the target. Rebalancing may require buying stocks with bonds or cash. This feels emotionally hard, but the rule helps you buy when prices are lower. When stocks rise dramatically, rebalancing may require trimming stocks and buying bonds. This feels hard too because you are selling what is working. But the rule protects you from becoming overexposed to the winning asset at the wrong time. That is the 28th principle. Rebalancing makes you do emotionally difficult things in small structured doses. This is why it is so valuable. It does not require you to predict the future. It only requires returning to the plan. Now, let us talk about expected returns and realism. A 7% annualized return over 30 years can create powerful outcomes, but the path will not be 7% every year. You may have a year down 30%, a year up 20, several flat years, a decade that disappoints. A decade that surprises. Annualized returns hide the emotional experience. This is why new investors must understand the journey before starting. The 29th principle, a long-term average is not a smooth path. If you expect smooth, you will panic when the normal volatility appears. You must know in advance that the account will fluctuate. The system is designed to keep you from reacting badly to that fluctuation. Now, let us examine the 30-year outcome. $10,000 at 7% becomes over $76,000 without additional contributions. That is compounding. $10,000 plus $200 per month can become over $300,000 over 30 years under the model. That is compounding plus contributions. The difference is enormous. The initial capital matters, but the continuing contribution changes the result. This is why people should not think of $10,000 as the whole plan. It is the starting base. The ongoing investment is what keeps feeding the machine. The 30th principle, A1, time investment can grow. A repeated investment can transform if you want the larger outcome. The monthly contribution matters $200 per month may not feel easy for everyone. Start smaller if necessary, but create the habit and increase it when income rises. Now let us talk about human capital again because it may be the strongest accelerator. If you can raise income, the investment contribution can rise. If the contribution rises, the portfolio grows faster. If the portfolio grows faster, returns become more meaningful. If returns become more meaningful, financial freedom becomes more realistic. This is why your career matters. Your skills matter. Your network matters. Your health matters. Your reputation matters. Your ability to earn is an asset, even though it does not appear on a brokerage statement. The 31st principle, your balance sheet does not show your human capital, but your future wealth depends on it. Investing in yourself can have extraordinary returns. A new skill, certification, career move, business idea, or improved productivity can increase lifetime income far more than a small difference between funds. Do not neglect the portfolio, but do not neglect yourself either. Now let us think about stress. One of the goals of asset allocation is to reduce daily anxiety. If your plan forces you to check charts every day, it is not a good plan for a normal life. A passive allocation should free your attention. It should allow you to focus on family, health, hobbies, and career. Money should serve life. It should not consume life. The 32nd principle. A financial plan that steals your attention every day is too expensive, even if the fees are low. The hidden cost of overactive investing is mental energy. If you are constantly worried, you may make worse decisions in work and life. A simple system can reduce that burden. Now let us talk about the emotional reward of seeing the account grow. At first, growth is small. Then the account reaches a level where the change becomes visible. Dividends arrive, the value rises. Rebalancing happens, automatic transfers continue. Over time, you begin to feel that the system is real. This creates confidence. Confidence increases consistency. Consistency increases compounding. The cycle strengthens itself. That is the 33rd principle. Early discipline creates later confidence. Do not wait for confidence before acting. Act in a structured way, and confidence will grow as the system proves itself. Now, what if someone is afraid to start with $10,000? They can start smaller. The source says $100 or $200 per month is fine. The point is to build the habit. You do not need to do everything at once. You can begin with a partial allocation, learn the platform, understand the funds, and increase over time. The worst outcome is to remain frozen because the perfect plan feels too big. The 34th principle, start small enough to act, then grow the system. Action creates feedback. Feedback creates learning. Learning creates confidence. Confidence creates larger action. This is a good sequence. Now let us discuss what $10,000 should not be used for. If this $10,000 is your only emergency money, do not invest all of it. Keep the safety net. If you have high interest debt, the priority may be to reduce that debt before investing aggressively. If you need the money for a near-term house down payment, education payment, medical expense, or essential purchase, the allocation should be different. Long-term investing requires long-term money. That is the 35th principle. Money needed soon should not be forced into long-term risk. The $10,000 allocation assumes this is money available for building a financial system, not money needed next month. If the money is needed soon, safety dominates. If the money can stay invested for years, growth can play a larger role. Time horizon determines risk. Now, let us think about inflation again. Inflation is why doing nothing can be costly. It is also why investing in productive assets matters. Companies can raise prices, grow revenue, and adapt. Bonds provide income, cash provides liquidity. A balanced system gives you exposure to different responses to the economic environment. A bank account alone may not protect purchasing power. A reckless investment may expose you to loss. A layered allocation balances these realities. That is the 36th principle. The answer to inflation is not panic. It is owning a thoughtful mix of liquidity, growth, and flexibility. Now, let us talk about insurance savings policies and fixed deposits. Some people choose them because they feel safe. There is nothing wrong with safety when safety is the goal. But if the return is below inflation or the terms are illiquid, the product may not build wealth efficiently. You must compare real return fees, lock up periods, liquidity, opportunity cost, and risk. Do not buy something because it feels safe. Understand what safety costs. The 37th principle, every safe asset has an opportunity cost. Sometimes the cost is worth paying. Sometimes it quietly slows the entire plan. Now, let us think about the role of discipline. The system is simple. Diversify risk. Hold long-term. Execute with discipline. But simple is not the same as easy. Discipline means continuing when the market is down. Discipline means not chasing trends. Discipline means rebalancing when it feels uncomfortable. Discipline means investing monthly. Discipline means not spending the opportunity fund because it is sitting there. Discipline is the invisible asset. Without discipline, the allocation is only numbers on paper. The 38th principle, the best asset allocation fails if behavior does not honor it. This is why the system must match personality. If you know you panic easily, hold more safety. If you know you overtrade, automate more. If you know you procrastinate, set transfers. If you know you chase hot ideas, keep the portfolio simple, design around your weaknesses. That is systems thinking. Now let us talk about financial freedom. The source says this strategy will not make you rich overnight, but it can create the possibility of financial freedom over 10, 20, or 30 years. That is the correct framing. Financial freedom is not usually a sudden event, it is a progression. First, you stop living at the edge, then you build an emergency fund, then you invest consistently, then you own assets, then those assets grow. Then they begin producing returns large enough to matter, then your choices expand. The $10,000 system is one step in that progression. It is not the whole journey, but it may be the first time your money is organized in a way that can travel the journey. The 39th principle, financial freedom, begins when money is organized around future choice, not present fear. A bank account with no plan is not freedom. A portfolio with no safety net is not freedom. A system with liquidity, growth, and opportunity is a stronger beginning. Now let us think about why the second best time to invest is now. The best time was 10 years ago because compounding loves time. But regret about the past does not create wealth. The only available decision is today. If you did not start 10 years ago, the next best action is to create the system now. Do not wait until you feel 100% ready. You will never feel 100% ready. There will always be market risk. There will always be uncertainty. There will always be scary headlines. The question is whether your plan can handle uncertainty. The 40th principle. Readiness is not the absence of fear. Readiness is having a system that can act while fear exists. This is why the first action can be small. Open the brokerage account, list your assets. Identify your emergency fund, decide the allocation, set the transfer, buy the first ETF, schedule rebalancing. The first action matters because it breaks inertia. Inertia is expensive. Now let us bring this back to the opening image. You work 10 hours a day for money. If your money sits in the bank, earning little while inflation reduces its value, then the relationship is one-sided. You serve money. Money does not serve you. The purpose of investing is to change that relationship, not through gambling, not through speculation, not through day trading, through asset allocation, safety net, growth engine, opportunity bullets, automatic transfers, broad ETFs, bonds for stability, rebalancing, long-term holding, human capital development. This is how money begins working. The 41st principle. Financial management is not only about getting rich, it is about buying the power of choice. Choice to work differently, choice to handle emergencies, choice to avoid panic, choice to invest during downturns, choice to spend time on family, health, hobbies, and career instead of watching charts every day. That is the real meaning of the system. Now let me state the structure clearly one more time. If you have $10,000 available for a long-term financial system, consider dividing it into 3 layers. First, $2,000 is the safety net. This is liquid, low-risk cash. It is there to keep you from selling investments during emergencies. Second, $6,000 is the growth engine. This can be divided into 70% broad stock ETFs and 30% bond ETFs or investment grade bonds invested over 6 months if that helps you manage timing risk. Third, $2,000 is opportunity bullets. This stays flexible, perhaps in a money market fund or short-term instrument, and is deployed in batches when the broad market drops meaningfully, such as 15% from the peak under the source S rule. Then automate contributions, choose low-cost ETFs, rebalance every 6 months. Learn steadily without overreacting, grow your income, increase contributions when possible, hold long-term. That is the system. The 42nd principle. A good system tells you what to do before emotion enters the room. When the market is rising, the system tells you not to chase. When the market is falling, the system tells you not to panic. When your paycheck arrives, the system tells you to invest. When your allocation drifts, the system tells you to rebalance. When fear appears, the system has already assigned money to safety. When opportunity appears, the system has already assigned money to bullets. This is how you make money work while you live your life. Now, I want to be realistic. This will not make you rich overnight. It may not produce exactly 7%. It may not become exactly $300,000. Markets can disappoint. Interest rates can change. Inflation can stay high. Bonds can lose value. Stocks can crash. You may need to adjust. But the alternative is not risk. Free. The alternative is often letting money sleep while inflation works against it. That is also risk. The 43rd principle. The choice is not between risk and no risk. It is between risks you understand and risks you ignore. Leaving money idle has inflation risk. Investing has market risk. Having no cash has liquidity risk. Chasing stocks has behavior risk. A good allocation balances these risks instead of pretending they do not exist. Now let us think about the person who starts today. They may feel nervous opening the account. They may feel uncertain buying the first ETF. They may feel uncomfortable seeing prices move. That is normal. But after the system is running for months, the fear changes. The account becomes familiar. The transfers become routine. The portfolio begins to feel less like a casino and more like a machine. Then, after years, the results begin to show. The person who waited for certainty is still waiting. The person who started with structure is building. That is the difference. The 44th principle. The market does not require certainty from you. It requires time, discipline, and participation. Now let us conclude with the deeper lesson. $10,000 is not just money. It is a decision point. It can stay asleep. It can be spent slowly. It can be lost through speculation, or it can be organized into a system that protects you, grows with the market, and gives you ammunition when fear creates opportunity. That choice matters. If you make money work for you, even quietly, your relationship with your paycheck changes. Work may still matter, income still matters, human capital still matters, but now every dollar you save can become a worker. Some workers protect you, some workers grow, some workers wait for opportunity. That is how capital begins. This is the real meaning of turning $10,000 into $300,000, the lazy way. It is not about being passive in life. It is about being systematic with money. It is not about doing nothing. It is about doing the right things, automating them, and refusing to sabotage them. Build the safety net, build the growth engine, keep the opportunity bullets, automate the transfers, rebalance. Keep learning, invest in yourself, stay patient. Do not wait for perfect readiness. Do not let inflation eat the money while you are deciding. And remember this, you already work for money every day. The question is whether your money will ever start working for you. A $10,000 system can be the first real answer, not the final answer, the first answer. And if you build it correctly, fund it consistently, and give it time, the person you become 10 years from now may look back and realize that the most important thing was not the market forecast, the perfect ETF, or the perfect timing. It was the day you stopped letting your money sleep.